Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, looks like we got you on the right day. The Canadian Real Estate Association says that sales in August were up 0.9%, the fourth month in a row that sales have gone up. Are those numbers correct?
Yeah, no, they're not correct. They're an outright manipulation of the stats to create a message designed to benefit the pocketbooks of the realtors across Canada. The use of seasonal adjustments, Jim, in the last 4 months to create this new narrative that the Canadian housing market was getting busier again, in spite of the fact that every single one of those 4 releases, they've stated that sales year over year have declined, is mind-boggling to me. And what's even more mind-boggling, Jim, is the fact that the mainstream media picks this press release up and they reprint it across Canada hundreds of times. Now, what we look at this is from a different perspective. Statistics Canada last week came out with their latest data, and it said 78% of Canadians' net wealth, 78%, is held in residential real estate. That means only 22% of the nation's net wealth is not in the family home or some other form of real estate, to make a long story short. 78% of the nation's wealth is tied up in residential real estate, yet the Canadian Real Estate Association is able to produce these false narratives every single month, and the Canadian press doesn't call them out on it. When we're looking at the housing market, Jim, we know that every single move in the housing market was caused by something that happened a year or more ago. So these declining sales that you're seeing now, from the way that we measure the market, would have started back in the fall of 2015. The fall of 2015 is when the fall of 2016 is when the signals came. What your listeners don't hear from organized real estate, or they don't hear from mainstream media, when they're going out to make the largest financial decision of their lifetime, 78% of Canada's net wealth is the family home. I'm going to keep stressing that today. Was in November of 2016. The Canadian banks pulled a little con job on everybody. The same con job that they pulled at least for the last 25 years. They manipulate interest rates the moment that the housing market starts to correct or slow down. So back in October of 2016, the housing market was into its third consecutive month of flat sales, meaning August, September, and October in 2016, year over year, sales were not increasing. This is including increasing geographical range, adding for sale by owners, every single thing the Canadian Real Estate Association and local real estate boards could do to inflate the numbers, it no longer was working. Immediately in November, the banks played their little game, and they increased the mortgage discount, the 5-year discounted mortgage rate by 0.14%. That's all that it took. Fear and panic set into the marketplace with people who had pre-approved mortgages, and they rushed out and bought. That caused everything that happened in the spring of 2016 to take place. Yeah, so I'm 15 to 16. So excuse me here as I got to backtrack. I need to be on the record here correctly. The spring of 2016 to take place. In that spring of 2016, everybody out in British Columbia knows what's happened. And then we know what happened in the follow-up. First-time buyers were hoodwinked by this bump in interest rates. Because what the banks then did, once that was exhausted, they lowered the 5-year discounted rate once again to continue to spur on the market. The banks themselves, Jim, were able to generate an additional 40,000 sales of resale homes in Canada year over year, October of 2015 to October of 2016. That's what the Canadian banks were able to do. Now, in that period of time, the posted 5-year rate didn't change. It was only the discount rate that was manipulated. So when we see the comments today coming from the Canadian Real Estate Association, saying for 4 consecutive months, the housing market has started to get busier again. And we're looking at our data, we see for the last 4 consecutive months, fewer and fewer homes have been purchased across Canada by Canadian home buyers. How can more homes be selling when fewer home buyers are buying the homes? This is how they use their seasonally adjusted numbers when a market starts to correct or contract or roll over. And they've used this to fool the Canadian public. What you're reading today is another myth, another falsehood, another way to try to convince Canadians to go out and buy a home and try to stave off this correction. How we would word it to everybody was, since October of 2015, and all the members of the Wealthy Homeowner know this, especially in the province of Ontario, the housing market was first contracting and is now correcting. Our data, you cannot argue. When you chart it, it is black and white. But we're not talking stats, are we, Jim? What we're talking is data. We're talking about interpreting the most important asset class in this country. 78% of Canadians' net wealth is held in residential real estate. In the for that other 22%, the other 22%, which is in the financial markets, pension funds, wherever it is, there are tens of thousands of professional financial advisors across Canada to help Canadians out with that. But in the 78%, there is only one firm in Canada who deals with home ownership wealth. One. And that's why you have the problem you have today, where the Canadian Real Estate Association says one thing, mainstream media picks it up and reprints it. It is a falsehood. And the general commentators out there talking about the housing market, i.e. academics, economists, realtors, bloggers, none of them would have told you what I just told you about the fall of 2015, how a little tiny 0.14% change in the discounted bank rate sent the market on for another year. Hopefully your listeners will know what I'm telling you here is the truth. By going back and listening to all the old House Street forecasts shows that we've had here and challenge me on any of the topics we've talked about in the past.
We'll have more with Ross Kay right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, just to make it clear about what we were talking about before the break, is that sales have been going down the last 2 years, yet the Real Estate Association says they've been going up the last 4, and they say that's all seasonally adjusted. What season?
Well, what season? Right, exactly. So there is seasonality to real estate, but it's not you cannot use a seasonally adjusted number to talk about monthly housing stats. Yes, there will, in certain parts of the country, in certain parts of the year, home buyers purchase at a higher rate. I will also tell you, Jim, that at certain parts of the year, certain categories of home buyers buy, and that is a pattern that is followed decade after decade after decade. You won't hear that in any of these commentaries. You won't hear about categories of home buyers. You cannot see, well, first of all, there's no need to seasonally adjust housing data, Jim. To be quite blunt with you, there is no need to seasonally adjust housing data because every single change that is made into the market was recorded a year to 2 years ago, and you're only reading about it today. If you go back, like I just mentioned in the previous section, and check what the banks did to interest rates, the mortgage discount rate in November of 2015, you're going to see how the banks manipulated the rate. Every single turn in the market, Jim, every single turn is tied to interest rate. Again, you're not going to see that in the press. You're not going to see that from any academic. You're not going to hear that from the government. But I can tell you, our data shows it is a 100% correlation that defies logic. Like it is so accurate, it defies logic. So, your listeners, if they were listening to us, we would have told you from the fall of 2015 forward, the housing market was slowing. Then we would have told you when it was, meaning it's a contraction. Then it would have moved into correction. The housing market has been slowing down since the fall of 2015. Sales have been negative, meaning fewer home buyers have purchased homes year over year for over 24 consecutive months. Over 2 years. Yet you won't find that printed in any newspaper in Canada. You won't hear about it anywhere except for right here on Howe Street, because this is the place where we have limited our commentary to, because you give us a long enough period of time on air here, Jim, to be able to try to get our full message out while still trying to maintain our proprietary measures of the housing market. I mean, I'm not coming on here and telling everybody what's going on in all the marketplaces in Canada. That's what our firm is paid for. But I can come on here and tell you what we read 2 years ago and why you're reading about it today in today's sales. Go back and check the mortgage rate, the discounted mortgage rates, and see how the banks play the game. And you'll see what the consequence is right now. Because of the banks, approximately 180,000 families, 180,000 families could not resell their home today for what they paid for it.
Ross, we've heard about an article where an Ontario couple said the value of their condo, I believe, went down 30%. They're wondering what people should do.
Yeah, so this is the problem when you're not looking at your home as it's your most important investment. This is what happens when you're looking at your home as just as it's a place to live, and the security that you have because someone can't kick you out when your rent comes up. Your home is your single largest investment. Statistics Canada says it's 78% of Canadians' wealth is residential real estate. 78%. When a home buyer listens to organized real estate, academics, economists, bloggers, realtors, and goes out and purchases a home, when the housing market has already signaled you will see falling prices, it not only is it unethical, it is just so destructive for these families. There are families, Jim, in a new market right now, young first-time home buyers who went out and purchased their first townhome. That townhome that they purchased for $1.1 million, they could not sell it today for $700 because their neighbors were trying to sell it for $700 and they couldn't sell it today. They listened to all of these voices out here trying to be experts in the housing market and trying to justify everybody listening to them or going out and buying a home or going out and placing a mortgage or going and putting your family in more debt instead of treating home equity, the home, with the respect it deserves. When 78% of the nation's wealth is tied up in residential real estate, that asset should demand the highest respect of any asset in this country. Now, we know how important homeownership wealth is to Canadians because we've tracked it for so long. We know the change, the change that it makes in people's lives. We know the consequence of what happens when people don't become homeowners. At the same time, we also know how a young family can lose $400,000 by listening to banks and realtors and everyone else in the spring of 2017 and waking up in September of 2018 and finding they've lost all that money. There is nothing like homeownership wealth and homeownership debt because this is the only asset that is leveraged. That leverage can work to your advantage or it can work to your disadvantage. You don't need to take on any risk. All you need to be told is the truth. If I'm going to buy this house, will it be worth less 6 months from now, a year from now, 2 years from now? Simply tell me the truth. Canadians are more than capable of deciding if they want to buy a home knowing that it's going to be worth less money a year from now. That's what our philosophy is. If they're going to own the home for a long period of time, Jim, or if they don't ever plan on selling the home, then they just need to structure their home ownership situation differently. But what you're talking about here with that 30% drop, we see that all over Ontario, Jim. Literally, I could find from the data tens of thousands of families that are in this exact same boat. And this is where a housing correction turns into a full-blown crash. Because when a young family who purchased a home with 20% or 25% down, that home is now worth 30% less than what they paid for it, they are fully underwater as owners. The only good thing about right now, which is a savings grade, is the amount of principal that you're paying off each month. And that along with inflation, along with house price inflation, will offset your losses going forward. That said, anyone out there who could tell me that young family should not have rather taken that $400,000 they've already lost and invested it with some financial advisor that they can trust somewhere in Canada for the next 2 or 3 years and probably rented off the proceeds of what they could have earned from that $400,000 invested, I'd be shocked if you could find where that would be in someone's best interest. Just give them the truth, tell them the information, forecast the market, accept that your forecasts are going to be right or wrong. If they're going to be wrong, don't forecast. If they're going to be right, forecast. Make sure, though, that you've got the historical data, so when the question comes up, prove what you're saying, you can prove it. And that's what separates the wheat from the chaff, as far as I'm concerned.
We'll have more with Ross Kay right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we've heard a lot about constricting credit recently as Canadians are not booking mortgages as rapidly as they once were. A listener asks, when the banks constrict or are conservative on mortgage credit, do home prices fall, causing the banks to further constrict credit, leading to a downward spiral in prices?
Okay, so for this listener, they are listening and believing the constrict credit now. So I can assure your listeners that every bank in Canada wants to lend as much money as they can. Their profit margins are based on how much money they can lend out, the spread that they're working with. There is not a bank in Canada who is constricting the credit. The Bank of Canada is not specifically constricting credit. What the bank is doing is they need to have interest rates high enough that people will save their money. They need to have interest rates high enough so that people will invest in Canada or the Canadian dollar. They need to have interest rates high enough to compete against the USA currency, the British currency, the euro, the Chinese currency. They're working on that premise. It's more of a global decision than it is local or Canadian. They're not doing it specifically to constrict credit. Rising rates naturally lead to borrowing less money while the payment remains the same. To us, when someone says constricting credit, that means that your monthly payments are going to be smaller. That's what it means to every single homeowner or family in Canada. It means that they're not going to be paying as much monthly in their principal and interest. That's what constriction means. That's not what it means to those people out there in the marketplace who are talking. They think that a smaller amount of mortgage debt or consumer debt. Now, consumer debt's a different story, and I believe consumer debt should be contracted. It's different than mortgage debt. But that said, those items are not constricting because of policy decisions. They're constricting, in other words, the amount of money that you can borrow because you're going to pay the bank more interest instead. Your regular homeowner makes 2 payments each month. He makes a principal payment. In other words, he pays himself a certain amount of the money that he has outstanding on loan from the bank, which shrinks the amount of money that he's borrowed from or she's borrowed from the bank. And then they pay an interest component for all of the outstanding money that they haven't repaid. That outstanding interest grows when interest rates rise. The principal portion shrinks or constricts. It doesn't mean that the payment changes, Jim. It doesn't mean that Canadians are wealthier at the end of the month. It means that the banks are wealthier at the end of the month because they are getting a higher percentage of your income in terms of interest, mortgage interest, consumer debt interest. So the constriction myth is simply a misunderstanding of how a housing market functions and how Canadians interact with their mortgage debt. Would you rather pay more interest to your bank, or would you rather pay more money into your home savings account? Because that's what a home is. A home is a high interest home savings account. That's what it is. It's your own personal bank. You're going to take care of that bank. When that bank has a broken window, you're going to replace it. When that bank needs a new coat of paint, you're going to paint it. When that bank needs a new roof, you're going to put a new roof on it. That bank is also going to reward you by allowing your family to live inside of it. All the while, you're paying down the amount of money you borrowed to get in, to own the home in the first place. Constricting credit does not do Canadians any good. If you want to constrict credit in a good manner, governments need to limit the amount of money that you can borrow. The governments won't do that. The OSFI rule changes, Jim, were specifically designed because of the greed of Canadian banks. What the OSFI had to do was to try to shrink the amount of money that people were borrowing, was they had to tell the banks, we no longer trust you to lend money prudently. We gave you terms that we have had for over 25 years. We will allow you to lend money at 32% gross debt service on average and 40% total debt service on average. We prefer that you're going to lend it rationally at 30% gross debt service or 25% gross debt service. But the bank's greed was overwhelming. The bank's greed stretched those lending limits up to 36% on gross debt service and up to 44% on total debt service. The OSFI saw that happening, and they saw Mr. Flaherty wasn't able to rein them in. Canadians weren't able to rein them in because the conversation wasn't about the truth. It was about making home selling and about the banks booking more mortgage debt. It wasn't about Canadians saving money, investing their money, and getting wealthier. No, it was simply to drive the housing market and the profits of all the stakeholders in the housing market. So the OSFI, after 25 years of everything being the same, was forced to act. They acted by effectively lowering gross debt service ratio and total debt service ratio by adding a new mortgage stress test. That's what has taken place in the marketplace. Your listeners, once again, try to find that printed anywhere by any of these so-called experts. That all the OSFI did was they lowered the maximum available gross debt service ratio. That's all that they did. And they did it because they can't trust bank CEOs. End of discussion.
Ross, buying a home seems to have gotten some folks into tax problems when buying from a foreign owner, as reported in the Financial Post last week. What tips would you give our listeners about taxes when buying a home?
Okay, so when the goods and services tax, Jim, first came into play, we had this problem rear its head for the very first time in Canada. Because when the goods and services tax was implemented, It meant that when a commercial property traded hands, there was goods and services tax applicable to it. If a real estate had been owned as a rental property, it meant that GST was going to be applicable to it. Now, there's ways to bypass that, but I'm just saying when GST first came out, that was a major risk for every realtor in Canada, because if you sold a property to someone and you didn't disclose that there needed to be a GST withholding done on that property, then you would probably lose your real estate license or be out of the business because you'd be sued. The fact is, the Canadian home buyer would still be on the hook for it. It would just mean that the Canadian home buyer, we were threatened that you're going to be sued. So what I can tell you, Jim, is from the first day GST became applicable, I've never sold a house, not once, without verifying first that there was not going to be GST on the property. I'll tell your listeners a quick story. There was one of the largest real estate brokers in Canada was located in Burlington, Ontario at the time, and they owned their own building. It was an old historical building located in downtown Burlington. I saw the property come up for sale because they wanted to move into a new plaza. I thought it was a stupid idea at the time, but it didn't matter. And I saw the property get listed for sale. The property was listed for sale at way under its value. I couldn't believe what it was listed for sale. I called up the broker, and the owner of the property, who's one of the largest real estate brokers in Canada, told me that his home was a heritage home. We call it LACAC here in Burlington, but it's a heritage home, and that the home could only be used for a limited amount of uses. So that's why it couldn't be renovated. There couldn't be any major changes, which is why he was moving out of it, and why the price was what it was. Well, I knew that wasn't true. I knew that property was not the way the owner of the property for the last 20 years believed it to be. I called in a local expert, one of the home inspectors that every realtor in my town hated because he was unbiased and he told the truth about his home inspections. So none of the realtors would use them. We used them every single time. He told me, of course, Ross, no, this house is not subject to heritage designation. I sold it to a hairdresser that I had known, a former boat person from Vietnam, purchased this property from one of the largest real estate brokers in Canada at a discount that was over 50% off the property's value because the real estate broker made a mistake. What I almost made a mistake was when I sold it to them, I didn't realize the property was going to be subject to GST. Luckily, prior to removing conditions, I did further follow-up and I caught my mistake. I revised the contract and I made the changes that were needed. Saved the client. What you're looking at with these foreign owners of Canadian real estate right now in Canada is the exact same thing. There is a withholding tax that is a responsibility of any home buyer in Canada who purchases residential real estate that is owned by a non-Canadian. You cannot rely upon your realtor to give you the answer or whether or not any home you purchase in Canada today, you're going to be subject to tax that you weren't counting on, that you were going to be on the hook for. In the case of this Financial Post report, it was almost $100,000. There are procedures that every single home buyer, Jim, in Canada needs to follow after this court ruling was handed down. And it needs to change the way that every single Canadian purchases their home going forward. Organized real estate is remaining hush. Why are they remaining hush? Because there are hundreds of thousands of sales pending right now where the realtors didn't do their due diligence to protect the client. They're hoping, as they always do, that these deals are all going to close and that Revenue Canada, because historically Revenue Canada never checked these things, won't understand what happened, and nobody will ever get blamed. It'll get swept under the rug, and once again, the realtors will wipe their brow, getting rid of the sweat, because they slipped by another one. Look, just be honest with people. Go out and tell every home buyer in Canada with a national ad campaign, if you're purchasing a home today, ensure that there is a clause inserted into your offer to protect you from subsequent CRA withholding charges, taxes that you did not withhold as the buyer of the real estate. These items have nothing to do with the buyer themselves. It has to do with the way tax law works. Simply tell every Canadian to be sure when you're buying a house, you have confirmed it is a Canadian owner. Of course, that brings up those FINTRAC forms, Jim. And since apparently FINTRAC forms somewhere in the last 5 years quit being followed up on as much as they were for the first 5 years that they were required, or first 10 years that they were required, there's that sweat now appearing on the realtors' foreheads. In the same month that they tell everybody home sales have increased for the fourth consecutive month, when the data shows home sales have fallen in each one of those 4 consecutive months.
Ross, a listener recently read a book called Burn Your Mortgage, and they're thinking of doing just that. What are your thoughts on paying off your mortgage as quickly as possible? And by the way, don't burn any mortgage documents. You'll need them.
Yes, you will. And don't burn your mortgage. Look, the worst advice given to Canadian homeowners is burning your mortgage. Because when you burn your mortgage, you are not diversifying your portfolio. Statistics Canada has just told us 78% of Canadians' wealth is tied up in residential real estate. That is a mistake. There is not a financial advisor in the world who would tell you to have 78% of your wealth in a single asset class. The reason why Canadians have been led down this path for the last 30 years is because the way that real estate agents sell homes, the way that banks book mortgages, is by getting people to move up the property ladder. The quicker you pay down your mortgage debt, the quicker you move up the property ladder. That's how it works. That's how millions upon millions of families in Canada have navigated the home ownership market. The advice that right now today we can still get a 3% mortgage for 5 years. Now, a 5-year GIC returns higher than that 3% mortgage does. It makes no sense to pay off these mortgages at these low interest rates. Now, your listeners need to understand, you still need to act as if you are paying down the mortgage at the same rate, and you still really want to act as if you're trying to burn your mortgage. The only difference is that you're off, instead of paying down your principal, investing in your home, going with that 78% non-diversification formula that Canadians are following, and instead call your financial advisor. We don't do financial advising with any of the firms that I'm working with. The Wealthy Homeowner does not do financial advising. That 22% of the nation's net worth, we are not experts on. We won't talk about it. What we will do, though, Jim, is we will show you where your housing price is going to go, how your home ownership experience is going to go, and how to take that money that you normally would be using to burn your mortgage, in other words, put in your home savings account, and give that money safely to a financial advisor with the proper instructions. So the financial advisor has to follow your instructions. In other words, they're going to invest the money in a way that there's very little to no risk, and you're going to offset some of the losses that you're going to experience in a correcting housing market. It doesn't make any sense to us, Jim, when we're sitting. The only reason that people want to pay off their mortgage because the answer is this. Well, what if I don't pay it down, or if I borrow money against my house, and what if my house drops in value? Well, lesson number one, your house still dropped in value. Lesson number two, if you had been prudent with those other investments, if you had invested in low risk or no risk properties, you would have offset some of the losses that you were going to take if you didn't diversify your home equity portfolio. We look at it this way, Jim. Home equity is part of your investment portfolio. It's part of your net wealth. We believe that all of the experts in the world who say you should not be heavily invested in one asset class, you should spread your investments around. We believe that is true. I think there is decades of data, or maybe even a century of data, that proves that to be true. We try to allow people to look at their home in a different way, to look in their home equity in a different way, and in a lot of cases, allow both spouses, to feel comfortable not burning their mortgage, not putting all their marbles in their house. Yes, you need to have a certain amount of mortgage paid off. Yes, you need to have so many marbles in your home. Yes, your home savings account needs to be a certain percent. But once that percent is reached, then you need to diversify your home equity portfolio to mitigate against risk. The easy answer to the burn your mortgage myth is this, Jim. If the average Canadian family who purchased a home in 1990, when interest rates were 13.75%, 13.75% on a 5-year term, if those people, instead of paying down their mortgage, in other words, instead of plopping down $4,000 in their mortgage because they had a windfall back then, they had bought a share of Berkshire Hathaway instead. And the next time they had $4,000, or I guess it would have been more by the next time they had it, bought another share of Berkshire Hathaway. And maybe if they were lucky, they would have used the time, their housing equity, to buy 4 shares of Berkshire Hathaway in 1990. I asked all of your listeners to go online today and find out what one single share of Berkshire Hathaway from 1990 is worth today. Imagine you still own your home, and your home is still owned mortgage clear, and your home is still worth the exact same amount whether or not you bought those shares of Berkshire Hathaway. The only difference was you would have paid a couple of $1,000s extra worth of interest over the 25 years that you own that home. That is the only difference. But you'd be sitting there $1 million richer. A diversified home equity portfolio provides that protection for you. Let us show you how to do it in a no-risk manner, and then go out and find some financial advisor who, first of all, vets us and says whether or not the information we're giving you is correct. Now, I know odds are they probably are going to say yes, it is, because they want to get your money to invest. So I understand that perspective. Talk to your lawyer. Talk to your accountant. Make a rational, facts-based decision before you burn your mortgage. Don't listen to some kid who did everything that he could because his parent was in the financial services community to write a book that encourages you to make a decision that is going to lead to financial devastation, which is exactly what's going to happen for those people who don't take advantage of this unbelievable opportunity they've been given, where interest rates are below 5%. interest rates, 5-year mortgage rates below 5%. And I'm going to say it to you this way, Jim, even when they're below 6%, this opportunity has to be looked at. You have to look at how I can grow my home equity as quickly and as much as I can. You are not going to do that by burning your mortgage.
Ross, thank you so much for chatting with us.
Hey, thanks. It's a long talk today, Jim. Thanks a lot.
My guest has been Ross Kay, home ownership consultant at thewealthhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.